Hello again, this is Dr. Lindsay. And what I want to do in this video is go over the supply curve for the firm that operates in this perfectly competitive environment. So first, we'll put costs here on the vertical axis and quantity on the horizontal axis. And remember, this average cost curve has this U shape to it. And the marginal cost curve intersects that average cost curve at its minimum. So let's see if I can draw this right about there. So there's the marginal cost curve. And the firm is a price taker. So the price is given. And we can see if the price is up here, we'll call this P star. That means that the optimal point and quantity for the firm to produce, the maximizing profits, would be right here where price equals marginal cost. So right here would be Q star, the quantity the firm produces. And if that price was to drop down, let's say it drops to this point here, P star, then we can draw a line here and say, well, now the firm is going to produce right here at this new spot where price equals marginal cost. Down here, Q star now will be right here, a little bit lower than before. So the price drops, the quantity supplied by the firm drops too. And you can see that because this upward slope of the marginal cost curve. Price goes up and the firm starts producing more. So that means that the supply curve for the firm is upward sloping because this marginal cost curve is the supply curve for the firm. And as the price goes up, Q star goes up, and price goes down, Q star goes down. So this is the reason why the firm has an upward sloping supply curve. And if all firms are identical in this market, that would mean that the market supply curve is upward sloping also. Now, what happens if this price drops down significantly lower to the point where the Q star now might be a loss? So let's say now P star drops down here. And the firm is trying to maximize their profit or minimize their losses, sets price equal to marginal cost, has a new Q star, which of course is lower as the price drops. Now the firm is losing money. Not a good position to be in. So what's the firm going to do? The firm has to decide whether they should stay in business or go out of business and exit if they're losing money. Certainly they're going to be staying in the business if they're making a profit. But what about a loss? Are they just going to exit the industry if they make a loss, or are they going to say, well, we'll stay in it for a while longer for whatever reason? Certainly, in the long run, if the firm is going to make a loss, they're going to exit the industry. That means at any price that's too low where they're making a loss, they will get out. So that means our supply curve for this firm in the long run would be this marginal cost curve here, but just the part of it that is above the average total cost curve. So I'll try to draw the long run supply curve for the firm. It's this purple line here. It's the marginal cost curve. But just that portion of it that is above the average total cost curve or equal to the average total cost curve. So right on that line too. But where that marginal cost curve is below that U-shaped average cost curve, the firm is going to be losing money, and they're just not going to stay in this business in the long run. They're going to exit. But what about the short run? What might they stay in the business if they're losing some money for a while? And the answer is yes. They may stay in the business for a while if they're losing money, as long as they're covering their variable costs. So we can think of these fixed costs as maybe sunk costs. They're money that was paid for some machines and they have no value once you sell them. Or it might be money that was spent on a lease, and if you leave early, you don't get any of that money back. So it's gone. But what if you're in this position? Yeah, you're losing money, but if you're looking at how much revenue you're getting and how much it's costing with the variable costs, then you might want to stay in business. You'll lose less that way if you could stay in business for a while. So we need to know what the variable costs are. Now remember, the variable cost, the average variable cost, looks very similar to the average total cost. It's U-shaped, it's just lower. So let's draw the average variable cost curve. It's going to look something kind of like this. This is the average variable cost curve. If we want to know what the average variable costs are, then we just multiply Q star by what the average variable costs are at Q star. And in this case, then, our average variable costs would be this rectangle here in blue. But our average revenue will be this area here in red. So in this case, our total revenue is greater than the total variable costs. So although we're losing money because we're not covering our sunk costs, we are covering the variable costs. So there's this amount of money that we're making in revenue more than our variable costs. So although we're losing money overall, we consider all the total costs. We're actually, if we just look at the variable costs, the firm is making money. So in this case, the firm is actually going to stay in business for a while, as long as they're covering their variable cost. If they can't cover their variable costs, then they will get out of the business. Even in the short run, they'll drop out. So now we can say that the supply curve for the firm in the long run is this purple one that I drew. But in the short run, I'll draw it in green. The short run is that marginal cost curve that is above the average variable cost curve. So I'll draw that. Here is in green here. I can write it right on top of the purple. It's the purple curve plus a little bit more. So in the short run, the supply curve here for this firm is the green, which is the marginal cost. It's above the average variable cost. That's their short run supply curve. But their long run supply curve is a marginal cost curve that's above the average total cost curve, because in the long run, they can't stay in the business if they're losing money. In the short run, yes, they can stay in business if they're losing money, as long as they're meeting their variable costs. If they can't even meet their variable costs, then they're just going to exit the industry right away. So the short run supply curve of the firm, it's the marginal cost curve. The portion of it that is above the U-shaped average variable cost curve. The long run supply curve for the firm is the marginal cost curve. The portion of it that is above the average total cost curve. So remember this. The supply curve for the firm is essentially the marginal cost curve, as long as they're making money. In the long run, they got to cover their costs. So it's that marginal cost curve that's above their cost curve, the total cost curve, all their costs. In the short run, it's a marginal cost curve as long as they're meeting their variable costs. So it's that marginal cost curve that is above the average variable cost curve is the supply curve for the firm.